And we have another update for U.S. equity markets. A little bit more of a recovery here as the week progresses. And the U.S. dollar takes a leg lower to boot. So what happened? Was it the after-hour earnings numbers? Surely not. That didn't seem to be a big mover whatsoever. But as ever, the importance of macro data and what it means for the Fed really made itself known. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do is we're going to unpack exactly what occurred here and take a look at what it might mean going forward. We had some critical data here that came out and gave us some new and interesting perspectives on what's going on. But as ever, the main question that we're here to ask is, of course, what does it all mean? And so does this mean that stocks keep going higher? Does this mean that the dollar keeps going down? Or are we, in fact, looking at something that's a little bit more corrective? Are we, in fact, looking at something that is unlikely to be anything more than a pullback in what is an emerging trend in the opposite direction? So, first and foremost, let's take a look at the actual data in front of us. And we begin with what were some very jumpy numbers on the Purchasing Manager Index for April out of the Eurozone. As ever, by the way, all of this data, all of this PMI data is following the usual logic where 50 is neutral. You can see that's the line through the middle there. That's neither growth nor contraction. Above 50 is growth. Below 50 is contraction. The further you go above, the faster the growth. The further you go below, the faster the contraction. So what we find here is that the manufacturing sector in the Euro area actually did worse than expected, 45.6 versus 46.5 on the index. So a deeper slowing in manufacturing in the Euro area, that sector contracting again and at a faster rate than expected. But the real story is on the services side, where we see aggressive booming. 52.9 on that service index, much stronger than the expected 51.8, showing we are growing at the fastest pace in 11 months in the service sector in the Euro area. And of course, that is quintessentially important for the overall, the composite index, because as with most developed economies, the service sector is about 70% of GDP growth, about 20% in manufacturing, and about 10% is ag, give or take, rounding and painting with a broad brush, as it were. So not surprisingly here, as the service sector goes, so too does overall European economic activity. And so an 11-month high, 51.4 versus 50.8. Very, very emphatic results from the Eurozone, and not surprisingly, the Euro liked it, albeit not nearly as much as the pound liked similar results on its side of the ledger. Here, too, much better than expected numbers. Again, manufacturing stumbling. It had a bit of a peak above that 50 line in the March report. April sees that off, and we get back down into contraction territory, 48.7. Expectations were that we'd expand, so disappointing number there. But the overall number, 54 versus 53 expected, powered by, not surprisingly here, a buoyant service sector, 54.9 versus 53 expected. So very strong results here when we look at what's going on with Europe. And of course, the question necessarily then is, well, what does this mean for monetary policy expectations? What does this mean for what's going to happen with the local shares? What does this mean for what's going to happen with the currencies going forward? But before we get into all of that, the first step in this conversation is, of course, how the U.S. stacked up to what we saw here. And the direction there was decidedly less encouraging. Here's the U.S. results here, and they actually come through much soggier than expected. Expectations were that we'd continue to hold around this give or take 52 level on the index, and that is not how this went. Manufacturing slipped back under 50, albeit by a hair, so call it standstill, veering on slight contraction. That would actually be the first contraction so far this year. And then much weaker than expected on services, much weaker than expected than on the overall. 52.2 on the overall was the expectation. We ended up with 50.9. So we've essentially receded back to where we were exactly in December. We can see here that when we look at U.S. growth, we had at the start of the year this pickup from December into January. We then held right around this 52 area, and we are now back to where we were in this more anemic side of things, which tended to define the second half of last year. We can see the second half had this upswell, again, powered by services, the overall index up with services into about May of last year. Then we recede into about July, August, hold here, get a pop at the start of the year here in the first quarter, and we're back into this area. So very disappointing numbers out of the U.S. And it was ultimately these numbers that would be the most market moving on the day. And we'll see, of course, why in just a moment. But let's take a look first at what this meant for policy expectations all around. For the ECB, didn't really change things. Still looking for 72 basis points in rate cuts this year, despite the PEPI outcome. So that, of course, is almost 3 rate cuts. A full 3 would be 3 times 25 basis points or 75. So at 72, we're almost fully baking in the third cut. There's about a 96% chance of one. So certainly still on the dovish side of things in the wake of this data. In the UK, we narrow scope for rate cuts a little bit. You can see here between yesterday and today, there is a little bit of a readjustment, and that probably explains why the euro couldn't really make hay of its own numbers, whereas the numbers out of the UK certainly did a little bit more. The pound was a little bit bouncier, and there, of course, we had a shift from about 53 basis points yesterday to 48 now. So talk about give or take about a 5-point swing if we round it off to the nearest basis point. And nevertheless, still about 2 cuts in the outlook. 48 out of 50 here, still relatively commanding. So about a 96% chance that we get the 2 cuts. Obviously, yesterday at 53 basis points, they were fully priced in. And so what you really had was just a sliver of possibility at 53 basis points that you'd get a third cut. As of today, that's off the table, but that second one still very much on the board as likely. But of course, compare that with what's going on in the US. You can very clearly see here, we moved out a little bit from about 32 basis points out to 36. Ultimately, we got as high as 37 in terms of the cuts outlook, but it settled a bit into the end of the day. And so about a 4 or 5 basis point move here in a dovish direction, depending on what time of day you look at here. But by the close, we end up moving from about 34 basis points to about 36. So something like a 2 to 3 basis point ultimate move. And you do have to do some creative rounding if you want to make it smaller versus larger. If we go out to the third decimal point, we went from 33.5 to 36.5. So call it from 34 to 37 if you want to get really nitpicky. But the bottom line is there was a bit of a hawkish dilution here. And it was really these numbers that powered what we can very clearly see here was an emphatic rise in equities. And it was with these numbers that the dollar really got whacked. If we look at how it performed against its major counterparts, we'll just rattle off some basics here. NASDAQ was up 1.83% on the day. That was its biggest rally since the beginning of the month. The specific date here was April the 5th. Very similar story for the S&P. It was up 1.27%. That's actually a longer view. The last time we did anything like that was February the 22nd. So a very emphatic move from the S&P. And for the dollar, on average against its major counterparts, down 63 basis points or 0.63%. That's the dollar's biggest decline going back quite a ways. The last time we saw anything like this size of a move, we'd have to go all the way back to December of last year. December 21st, December 14th has analog moves. So a very meaningful correction here, and you can see that in the dollar right there. What's interesting, of course, is that we still have just 36 basis points here. So that's about a rate cut and a half, give or take. So if we consider here that 36 basis points gets us about 14 basis points on the way to a 25 basis point cut, that amounts to about a 56% chance of a second cut. So let's call it one cut and about a 50-50 shot on a second, leaning in its favor. That stacks up quite well against the 48 that's still in view for the Bank of England, and certainly the 72 that's still in view for the ECB. So as the dust settles here, we are left with a Fed that's still likely to out-hawk the other two major central banks, and so the dollar still likely to retain its yield advantage. So when we look at what that means here, this suddenly starts to look a little bit more like a correction, where here was a range, here was its resistance. We broke through that resistance last week, and perhaps we're pulling back to find some anchoring here before the next leg in this direction. It is a similar story for stocks. When you look at the S&P 500 here, ostensibly the line that really gets the break going is somewhere around here. And let's see if we can get this a little bit cleaner for you. Artistry, certainly not the thing that we pride ourselves on here on Macro Money. Right around there, let's call it. Somewhere in this area. So if that's what we're looking for as the kind of line in the sand, this bounce still appears somewhat corrective. We still look like we are in a trend that's pointing down. And the next question is, what is the next catalyst? What is going to move the needle? And we still have a little bit of economic data this week. On Thursday, we'll have U.S. GDP numbers. They're expected to be a little bit softer than the numbers from the fourth quarter. We talked about this on the show yesterday, a step down expected here from a 3-handle on growth to a 2-handle. The specific numbers here, 2.5% for the first quarter number expected from 3.4 in the fourth. If that comes up as a number that's going to be a little bit warmer than expected, then that might very well give us the place where this gets, once again, stuck and present an opportunity. Because, of course, what this bounce does, if it holds at these former levels that we've just broken here, clumsily though we've set them up here, if that's what we are looking at, then what this presents is an opportunity to be a seller at more attractive levels, perhaps, than we've seen since about the middle of last week. It is a similar story for the US dollar, where the pullback affords an opportunity to be a buyer at these levels. Now, of course, we don't have confirmation yet. We need to see these numbers, but clearly the markets are ultra sensitive to what is being signaled here, even in the minutia of Fed policy expectations. That, of course, makes sense. The way that the Fed moves here is going to define not just the cost of money in the U.S., but because of the ubiquity of the U.S. dollar in global commerce, it is going to define the cost of borrowing the world over. So for investors, the question here is the money going to be cheaper in the future? And therefore, I am inspired to take risk. Worst case, my trade goes wrong. The risky thing I do ends up being the wrong thing or doesn't work. Well, then I can borrow back with cheaper money and go again. As opposed to the money's going to be more expensive. Again, in relative terms. As ever, we are looking at forward-looking markets that operate relative to what is already baked in. So if we are going to have a situation where the money is going to be more expensive, that then sets up a situation where you don't want to take risk, perhaps, as an investor. And so you are going to be more inclined to hold cash and likewise more inclined to divest of riskier assets. So that starts to be a tailwind for the dollar and a headwind, for stocks. So if in fact these GDP numbers are going to be, let's say, in line with expectations or a little bit warmer, that's likely to be bad news for stocks, good news for the dollar. If they're a little bit softer than expected, that's likely to be not great for the dollar and more supportive for stock markets. But as ever, as long as these yield differentials hold in the dollar's favor, these moves afford opportunities to fade them. And as long as the market is still on the hawkish side of the Fed, stocks look like something to fade as well as they bounce here. Much like on the way up here, while economic data was deflating Fed rate cut expectations, the first quarter, of course, saw much better jobs numbers, much better CPI numbers, whole set of releases that were better than expected that narrowed us from these aggressive 6-cut expectations down to 3. But as long as we stayed below the Fed's benchmark and the market looked relatively more dovish than Fed officials, stocks could keep going higher. As long as we are now on the hawkish side of Fed officials, then you might expect things to keep going lower, with incremental shifts giving you swings around the overall direction, but that overall direction still seemingly pointed down. At least until we get into June and the Fed has the opportunity to revise this line itself. That'll be the next time it delivers its summary of economic projections. There's, of course, an intervening Fed meeting on May the 1st, where some flavoring of where officials are aiming at is likely to appear. We heard it from their rhetoric last week, including from Fed Chair Powell. They're feeling a little bit more hawkish. They recognize what's occurring here. And so when we look at this, it may not be the GDP number, it may not be the PCE number on Friday that ultimately arrests the bounce. But as we get into the gravitational pull of that Fed meeting next week, it does seem like we are likely to see stocks round out the correction and start setting up for another move lower, whereas the dollar is likely to find its support and start setting up for a move higher, assuming, of course, that these dynamics continue to hold and we don't get some sort of a rapid reimagining of the entire Fed calculus between now and then, which, of course, seems relatively unlikely. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where that leaves us for the subsequent day. I am likewise on with Chris for Futures Power Hour on Fridays, on with Tom and Victor for First Call on Sundays, back on with Victor on Wednesdays for The Price of Truth, his new show. Definitely check that out. I'll be back there this week again. Writing for the News and Insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilias Pivac. Thanks very much for joining. See you tomorrow.